Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. I think what we're looking at right now is a global aversion for long duration. I mean, think about it, right? Last week, the U.S. Treasury market witnessed a rather volatile period of trading activity. And of course, things got started with the market digesting the news of the Moody's one-notch downgrade to the U.S. credit rating. And then it was followed up with news that the House of Representatives had passed the big, beautiful bill pertaining to potential future fiscal policy. And these two events coming together put tariff-related concerns on the back burner for now and raised investor anxieties about swelling deficits and increased supply, otherwise known as debt sustainability. And typically the focus of bond markets is the 10-year maturity. However, when deficits, attendant supply, and debt servicing enter into the conversation, the focus tends to shift more to the longer end of the curve, or the 30-year sector. Why? Because when debt sustainability concerns enter into the fray, longer-dated maturities are viewed as potentially the most vulnerable. In other words, what would the federal government have to pay investors to buy their debt for the long run in order to compensate them for this added risk? So needless to say, at the height of last week's trading, the U.S. 30-year bond was generating the lion's share of the headlines as the yield eclipsed the 5% threshold for the first time since October 2023, and it peaked at 5.11%. Interestingly, at that time, there were concerns regarding the budget deficit and supply as Treasury debt managers raised the size of the U.S. note and bond auctions, and I'm referring to back then in 2023. Couple that with a Fed that had just finished up its aggressive rate hike cycle, and voila, you have a 5% 30-year and 5% 10-year yield at that time. Now let's fast forward to this latest episode where you have concerns about deficits, Treasury debt loads, and the Fed that's showing no signs of preemptively cutting rates. And the next thing you know, the 30-year bond yield topped out at 5.15% in intraday trading before finishing last week at 5.04. The 10-year yield didn't even come close to the 5% threshold last week. It peaked at 4.62 and finished only about 3 basis points higher on the week. It's more interesting, though, is that this rise in 30-year yields, it's not just a U.S. phenomenon. In fact, 3 of the largest other developed sovereign debt markets, their respective 30 years, have also witnessed visible yield increases year to date. And I'm talking about the UK, German, and Japan 30-year bond yields, where they have risen anywhere from 38 to 75 basis points. The U.S. 30-year risen by a more modest 26 basis points. And if you dig a little bit deeper, you can see that the German and Japan increases in their 30-year yields are 2 to 3 times the size of the rise for the U.S. long bond. Now ask yourself, were their credit ratings downgraded in the last week or so? Of course not. However, in the case of Germany, their federal government did recently vote for a massive increase in government borrowing to alter its debt brake, and that is a rather visible shift in their own fiscal outlook. So let's provide some perspective. A 5% handle on the U.S. 30-year bond is part of our theme of rates returning to normal. From 1988 to 2007, the average yield on the 30-year was 6.41%. And when zero interest rates and negative rates abroad showed up during the 2010 to 2021 period, the average yield plummeted to an abnormal 2.96%. And based on economists' forecasts that I've seen, even if the big, beautiful bill becomes law, and remember, the Senate still has to weigh in here, the fiscal year 2026 budget deficit is not projected to increase by an astronomical amount. Those $3 to $5 trillion increase in debt projections, they're 10-year estimates. So is the U.S. fiscal path sustainable in the long run? I'm definitely in the no camp. However, more nearer term, if the Treasury debt managers can manage to keep note and bond auction sizes relatively constant over the next year, the fundamentals will, as is usually the case, return to prominence. So bottom line, in my opinion, let's go back to the beginning. I think what we may be seeing right now is just a case of global aversion to duration. Have a great rest of the week, everybody, and be well.